Right. So we're back again after Easter bank holiday weekend, which was a super long break. I actually had an annex video uploaded over the Easter break on Good Friday, actually, where I elaborated further on the previous episode, which was about derivatives, and I explained about margins, futures, options on futures, and options themselves also. So do give that do check it out later when you have a moment that explains a lot more into depth what I couldn't cover in episode 6, which I really rushed over quickly. Anyways, this is now the second last of my 8 episodes, so to speak, on this matter, wherein I'm trying to educate my peers or anybody who's watching really on the world of finance. Again, just a couple of disclaimers: this is not financial advice; it's only my opinions. The content is for educational purposes only. It's trying to get across the idea of how to invest and what you can invest in, what's out there, and other things out, other options available to you. And of course, content is being recorded so that it can be uploaded to YouTube for reference at a later time. So yeah, let's crack on. Just oops, sorry. Yep, there we go. So just recapping what we've covered so far. We were actually in the seventh of 8 episodes. So in this episode, I'm hoping that we can all put together everything we've spoken about in the last 6.5 episodes. I'm hoping we can put it together. You can begin to uh visualize or think of how your portfolio is going to look like. So oh wow, enter and the buttons don't. Okay, it's weird. My enter button doesn't work right now. Anyway, so this is just a recap from one of the very early episodes we did, and I just want to bring out, I just want to point out that the instruments that we have available to us, that we can, invest in. And this is my personal preference in terms of risks. So the least risky options are at the top, and the most risky are at the bottom. Of course, it's up for debate as to why metals are a bit more risky than stocks, etc., or real estate down there over metals and so on and so forth. But it's just something the way I look at the world. So feel free to shuffle these around for yourself if you need to. And that's just what out there. And of course, investing is a risk reward linearity curve, so to speak. So the more you risk, the more you're likely to make. I was actually having a discussion about this with my colleague earlier today, wherein you could go completely risk averse and just invest in either government or corporate bonds, but the yield on these aren't that significant. They're like 1%, 1.5%. I think the 10-year Treasury yield right now, which is American government-backed bonds, are giving like 1.4, 1.6% right now, which isn't much compared to crypto, Bitcoin having gone up, I think, a couple of 100%, like 600% over a year. The same way, ETFs, which funds or ETFs, which are a mixture of bunch of stocks. I think my personal ETF is up like 40% since the March crash, whereas independent stocks like Tesla or Zoom are up several 100%. The same with real estate prices are booming, and you got derivatives which magnify the gains you could have made with stocks or funds that you pick derivatives off. So it's pretty straightforward. It's a risk reward ratio, wherein the more you're willing to risk, the more you're capable of making. So that's why you have all these SPAC millionaires, as well as people buying Tesla calls back in March of last year. They're really printing today, or well, early on in the year, so to speak. But I hope I get the point across, wherein you gotta understand, you gotta try to comprehend where you think your risk threshold is, and based on that, you can begin to build a portfolio around. When if you think it's going to be super risky, where you want to go all in, you might as well try a bit of crypto, or mix it up with some really risky tech stocks if you feel like, some startups, even some penny stocks. And I think trying it out there, just having your money on the line, and seeing double digit or single digit drops in terms of percentage, that really puts into perspective where you really stand. So the first time I had like I used to remember, I used to invest, or rather gamble, with penny stocks a couple of months ago. And it really put into perspective what I thought my risk tolerance was, where I thought it was a 9, but really I was getting panicked every single time my stock fell a few pennies, which in percentage terms was single digit percentages. So I found it was a bit too stressful for me, and the fact that it was actually gambling, because you don't know what's going up or why. is it was quite something I don't want to be involved in anymore. So it taught me a lot about what instruments work for me. Penny stocks aren't one of them. Big cap or large market cap stocks, which are greater than $10 billion worth companies, they were. That's what I began switching my efforts into. And ETFs make it a bit more easier as well for me to digest what's happening out there. So it's completely a personal choice what you think you can risk or what you're willing to risk. Considering your age, your profession, your interest in financial instruments, and so on and so forth. Right. So again, I'm just going to try to break down how you can begin to think of a portfolio. So first, you got to find investments that that suit your goals. What you're trying to find a goal that you want to invest for, like a house or a child or the child's college fund or whatever, and then try to find appropriate instruments that help satisfy the goals that you want to achieve. And then, of course, you want to define your terms in terms of liquidity, like how easily you want to be able to get in and out of your investments. Like if you buy and sell houses, that's going to be a lot less liquid than buying Apple shares, which trade in the millions on the daily. You got to think about how much capital you have available to invest. Some people have a grand, some people have 10 grand, some people have 10 million quid. So you got to see how much money you're willing to put at risk, and then obviously how much risk you're willing to take with it. And of course, the time horizon, the longer you're willing to wait, um, statistically, the more you're likely to make. You can throw your money at any decent investment, any decent company that's out there right now, Apple or Facebook or a bunch of them, like an ETF that combines them, like the S&P 500. And over time, you will see that these investments will grow. Maybe not in a year, maybe not in two, but 10 years from now, I can definitely guarantee you will see at least double-digit percentage growth, which is quite weak, to be honest. If you're not seeing doubling of your investment over a 10-year period, then something isn't right. Of course, you've got choices for ESG investing, which is environmental social governance. It's a new theme that's has taken hold, wherein people invest in companies that do not contribute or do not involve themselves with things like alcohol, weapons, tobacco, and stuff like that, or companies that give gender bias, that do not have gender bias, so to speak, within their upper management, or other metrics, so to speak. Of course, you got investments to hedge, so you can buy puts as a hedge towards if you think the market's going to fall, you can go and buy yourself some puts, which is what we discussed last week. Or if you want to make money off it, you can actually sell some calls. So it's either or, depending on how you want to view uh, your risk tolerance. Of course, you've got trading as a form of investing. So you can, of course, trade stocks regularly. Once your timeline could be anywhere between holding for months, years, or even look at derivatives. So, selling puts is a bullish strategy. So people can invest by selling puts. In fact, there is a statistic wherein over the last 15 or 20 years or so, if you employed 18% of your capital to selling puts against SPY, of course you need a bit of capital to do that in the first place. But if you invested just 18% of your capital as selling SPY, about 30 delta puts, you would make just as much money as buying and holding SPY with 100% of the capital. So you can have instruments that help you use your capital more efficiently if you're into that kind of thing. And of course, each of the points above have their own strategy of management, have their own pros and their cons. So you gotta sit and view what you've got time for and what you're willing to put forward. And the best thing to do is try to educate yourself on what's available right there, to help you achieve your goals. I mean, by listening to this podcast or well, episode, by watching this or listening to this, you're actually taking the very first step into understanding. So I think the point of these episodes were to give you a floor to stand on. Now, I think most of you should be able to understand how the mechanics of the stock market works. So when you click the buy button on a stock, you know what's happening behind the screens, or an ETF. you know you kind of, I hope you can go back and look at your pensions. You can see what funds your pension is invested in. You can even take matters in your own hands and adjust your pensions according to what you think your risk tolerance is. And of course, I'm hoping that you're able to look at ETFs or funds, or able to understand what these instruments are and how you can access them. And of course, I hope you can judge what's right for you to actually put your money to work for you, because that's the only way someone's going to grow wealthy, so to speak. I mean, you can do a job for 50 years, but that's not going to get you really wealthy unless you are absolutely committed to it. And that's quite rare, to be honest. To see that kind of commitment when you make several millions over just your primary source of employment. Again, I mean, I cannot stress this enough. You got to learn to diversify your portfolio. So if you think about stocks like just Apple, just Facebook, there's literally a 50-50 chance of what's going to happen over the next year or next 2 years, maybe even the next 3 years. It's only when you look at the long term horizon where you will see a definite upside. But within that time frame, within the 1 year time frame, or within even 3 months time frame, stocks can go anywhere. They could go up, they could go down. Nobody can guess what's going to happen. Not the gurus on CNBC, not myself. If you got a hunch, you have a 50% chance of being right or wrong. Literally a 50% chance right there. You can diversify by means of looking at ETFs. So the S&P 500 is the 500 biggest companies in the US. So that would give you a much smoother ride than just Apple or just Tesla. So if you look at just the chart of Tesla, it's going to be really choppy compared to the S&P. However, the S&P is a highly correlated bunch of instruments together. So you still have the tight correlation within the instruments of the SPY. So if the whole market crashes, SPY will, SPY or the S&P will definitely crash just a little bit less, because you've got some stocks that may, hold themselves up. You've got other instruments like metals in terms of ETFs or physical metal, even if you hold it, bonds, commodities, real estate. They are somewhat semi uncorrelated. I mean, in a massive sell off, if you look at the coronavirus sell off last March, everything is going to sell off, but some things will sell off less than others. So bonds went down like single digit percentages, whereas stocks went down -40, -50, -70%. I think travel industry was crippled last March. So you can use other instruments to hedge against risks of investing in a market, but of course they're all somewhat correlated to an extent. It's extremely difficult to find something that's completely uncorrelated. I mean, you can get to minus point one or minus point two in terms of correlation, where zero is perfectly uncorrelated and -1 is strongly negatively uncorrelated. You can get to -1, -2, minus point 0.1, minus point 0.2, but it's difficult to go beyond that unless you're trying to use, exquisite techniques to do so. And so it's best to diversify across instruments. So feel free to invest in ETFs and stocks and bonds and real estate, if you feel like it, across strategies. So you want to mix up a couple of strategies. So you want to mix up your long term and short term strategies, and across time horizons. So you want to have a retirement fund going in the background. It could be with the ISA, it could be however you prefer, with a different broker entirely. And you could also dabble with stocks and trade them on a short term basis, because you think the next iPhone is going to be really big, or the next Microsoft Surface tablet is going to blow waves across the industry or whatever. So it's best to try to diversify as much as you can to keep your eggs in as many baskets as possible. But that's from a passive investing point of view. So this this entire episode is quite heavily biased towards benefiting passive investors. I don't want to discuss much about active because it's so frowned upon, but I myself am an active investor, where I look at what instruments are out there and try to help me identify what can get me ahead of just investing in the S&P 500, for example. So that's just the two boats to be wary of. Right. So as an investor, you cannot control the direction of the market. I mean, there's no matter how hard you try, unless you've got a couple of billion quid, you're not gonna make a drop of difference in the market. Is the market is just like worth 85 trillion US dollars. Well, the US stock market alone, the whole world's economy is a bit more than that. Oh yeah, I think those numbers are about right. But the stock market's worth about 85 trillion US dollars. So unless you've got like $1 trillion, which literally no one on this planet has, I mean, entire companies are worth 2 trillion at most. It's difficult to make a movement in the market. So the best thing you can literally do is control your own costs. Now, costs can be incurred by the platform you use to invest in. So, brokers may charge you a cost for either transacting or even just holding an investment with them. I know for a fact that I think H&L, highest grievance charge you like 0.45% ongoing charge. Vanguard charges 0.15%. Trading 212 is a 0%, so they don't charge you anything for holding your instruments with them. And of course, if you're buying investments in a currency that's not your own, you will incur a currency conversion, either a loss or a fee. So the currency rates might not be as good as you expect. It might not be what you see on Google. It might be less. So you may lose money that way. Each fund, so of course there are managers who sit and rebalance these index funds every quarter, and even though they do it so rarely, they're still going to charge you money. No one's going to do it for free. So there is the ongoing charge of the fund, OCF. I think that's what it stands for, but that's pretty much what it is. It's an annual charge that's applied on your profits within the fund itself, and it's taken from the fund regardless of the fund outperforming or underperforming, or regardless of fund performance. That percentage is taken out of the fund itself and to pay for the managers that run it. So you won't actually have to pay the fund management fee. You will just see a less return than if that was zero or didn't exist. So you've got fund management charges, which are the fund expenses for the fund to manage for the fund to pay its managers, or to do the rebalancing every quarter, every month, every day in some cases. And of course, the fund itself would convert currency on your behalf. So even though you're paying pounds to buy the ETF VWRL, which is a Vanguard ETF, the fund itself, Vanguard, is buying US stocks in US dollars, even though you are buying the British version of it, which is on the London Stock Exchange. So they're going to charge you for the currency conversion as well. It would be microscopic per investor, but when you're trying to handle billions of dollars of investments, which I'm pretty sure VWRL is a couple of 100 million, but when you're handling a couple of 100 million in investments, those currency conversion charges add up to a lot. It's just that there's so many investors that it gets divided into fractions of pennies or fractions of pounds for people to deal with. And of course, there are taxes. Now, I've never spoken about taxes so far, but that's something you gotta consider in your residence. Of course, I would. It's always better to use tax eased accounts. I would have said tax free, but a SIP isn't exactly tax free. A SIP is like a personal pension that you run alongside your employer's pension. So you manage a SIP entirely. You have full control of it. It's nothing to do with your employer. You don't get a contribution from them. It's just the government, in the UK at least, the government will give you some tax benefit for investing in a SIP. And of course, you got ISAs, which are of course tax free, tax exempt accounts. So any capital gains made in an ISA account are tax exempt. So if you invest it in Tesla in an ISA, and you've 6 times your money or 7 times your money, you paid no capital gains on that particular investment. And the Americans have their Roth IRAs, which are a lot like ISAs, I think, and they've got their 401ks, which are a lot like SIPs in the US. And different countries have different tax laws. So just keep an eye on how taxes affect you, because there's no point in investing in an ETF which pays you, there's no point in investing in an ETF for 1 year if the ETF's projected growth is supposed to be 7%, but you pay like 20% in taxes. You're just going to go backwards. In which case, you might as well, find other instruments locally that might help you get better. It's always worth looking out that if a cheaper fund is available on a different broker than the most advertised, it's worth investigating or even moving over or to start there. So, as long as the broker is reliable and cheaper, and as long as the fund is suitable to your requirements, then it's always worth cutting your costs as much as possible. Of course, keep an eye on the costs to move itself. Some brokers will charge you an exit fee, or the transfer fee, or there's that bollocks and stuff like that. Some generic fees they'll just add on top. So of course, considering all that, you need to look at the big picture. If you're still going to make money or recoup the costs of moving across within a year, within 6 months, within 2 years, and your investment horizon is 10 years, then it's worth making the move across. So for example, as I mentioned, Vanguard will charge you 0.15% for your funds held all the way, I think, up to, I think it's capped at a specific number. I think it's capped at £45 a year. Uh, so at some particular number, I think it's about 100, about 25, 30K. At that point, once you have 30 grand in investments, it's worth moving to a different platform which may charge you a fixed fee. For example, I think iWeb charges you an annual fee, if I'm not mistaken. I'm not exactly sure. I think it's just something I've heard. But some platforms will charge you a flat fee, £10 a month, a year, sorry, £10 a year, plus some extra charges that they make up their money with. But it's always worth looking at what brokers and what funds are out there, especially the increasing competition in the UK especially is bringing costs down really quickly. In America, this competition is already well rampant, so they've got almost 0.03% funds, or 0.0% funds that are recently coming out, and even some platforms are going a lot of platforms are going to 0% charges, and they make their money by other means, through data rather than through commission. Anyway, so that's something to keep an eye on, especially if you invest passively. And of course, once you've identified what's right for you, all you gotta do is like watching paint dry. Just it's one of the investing is one of the handful of activities that pay you to do nothing. There's a market crash happening. You just gotta calm your nerves and wait it out. People who saw the market crashing in February, all the way to the bottom in March, and if God forbid somebody sold out on March 23rd, which is the bottom of the market, they've realized their entire losses, and only if they held, which required a lot of nerves, to be honest, all the way through to I think September is when it was break even to the highs of March, and now we're hitting all-time highs again. So we're slightly higher than what we were same time last year. So it takes nerves to hang on to your investments and watch a 40% drop. It's scary, trust me. But you gotta, if you're correct in your investment thesis, be it passive or active, you gotta, hold your nerve and just wait it out. It could take a year. It could take, I think 2008, the financial crisis was a 1.5 year event. It was a sell off over 18 months. So, over 18 months, the market went slightly lower or did nothing, and then went slightly lower and did nothing. And then until 2009, mid 2009 is when everything started to pick back up again. And, I may be wrong. It may be mid 2010. I'm not sure. But the whole event was about, 15 to 18 months. Whereas the coronavirus crash was like 2 months, started in Feb, bottom was March 18th, and we have recovered by September of the same year. It's like the fastest drop and gain in history, I think. So, right, daily market volatility is something that news outlets will milk at every opportunity they get. They'll say SPY has hit its or the S&P 500 index has hit its all-time high, and they'll keep milking that news until the next 2% or 5% drop comes around. But the underlying trend beneath all these daily movements is a slow march upwards as the world produces more value. Of course, the global economy in general is growing. By that I mean we are producing more valuable goods. These goods could be valuable in terms of adding value to our lives. The growth of tech, the introduction of the computer, the introduction of information, or using of information for benefit. All that is marching the economy upwards. So we as humans tend to contribute valuably, or contribute value to society, and that results in a country's economy, which cumulative with the rest of the world results to the world's economy. So just try and keep your nose slow. And as I said in my previous episode as well, most people are net long. So the general trend is to slowly go upwards. And by means of diversification and cost cutting, you have already mitigated all your potential risks. Any systematic risks that are involved in investing, which is a function of the market itself, you can't take that out. But by diversification and cutting your costs as much as possible, you've taken out whatever you can. The only variable now in play is time. I mean, there's nothing more you can do, or nothing differently you can do, and you just got to wait out and watch your wealth grow. Of course, you could look out for future, better investments in the future, and that's always a thing that's available. But if you're passively investing in an index fund, for example, then all you can do is just wait it out. And of course, if you've found a strategy that leverages a current niche market, or a strategy that is not diverse enough. So example, investing just in tech stocks or just in the UK stocks. There may be a short-term game like gain, over the coronavirus period. Everybody moved in the work to home stage, so tech stocks really rallied, and now you've got electric vehicles coming across. So you've got mining companies, you've got battery companies, you've got electronics companies, semiconductor companies that are really shooting up because of this growth in EV. But times are always changing. There's not always the tech is not always going to be the hottest sector out there. So you need to know when it's time to change your strategy and begin to reconsider what options are available to you. I remember back in the bottom of March, people on Wall Street bets were still buying puts, hoping that the market would go down. It became the consensus that the market's going to keep crashing. And I remember sometime around March or April, when the market began to bounce back up, people were still in denial, like, oh no, this is like a fake rally, and the market's going to keep going down. And they kept buying puts. So their entire account worth 200, 300K went to zero as their puts expired worthless. So you got to know when to change your strategy. If you're planning a bespoke strategy, you got to know when to pivot away and look at something else. And of course, you gotta keep keeping an eye on your portfolio. You got to rebalance accordingly. This applies to both active and passive. You got to make sure your portfolio, or the invest or the instruments within your portfolio are within their allocations, because some things might increase in value, some things might decrease in value, so there might be a misbalance. So just make sure you rebalance them once a quarter, once a year should be good enough. And then make changes until you find something that works for you again, and then stick with it until you feel like it's not working out. But just ensure you give it enough time to materialize. It's completely personal as to if you want to give your winners time, if you want to take your winners off and take your profits as soon as you make a certain percentage. It's completely down to an independent investor. It depends on how actively or passively you want to keep an eye on. So uh, right. So passively, I'd suggest try to find a diverse a diverse ETF or a fund, whatever suits yourself. Try to find decent hedges. Like I use Right. Sorry. Yeah. So I use metals and commodities. I use gold and commodities as a hedge for my personal ETF or my stock portfolio. But I also dabble in derivatives. So I play around with what I think I'm willing to risk. And of course, as a young person, I also have some crypto in my portfolio, a bit more than I'd like, but it exists. I don't touch bonds because I think that the yields are too little for what I want them to be. And in terms of real estate, you could have it as a physical real estate, as in your house is an investment if you look at it that way, or you could invest in ETFs that manage real estate exclusively. They're more often labeled as REITs, REITs, so REITs, real estate investment trusts, REITs. So you could actually invest in real estate across the globe using REITs if you need to. If you don't want bias towards your own country, for example. So if you picked something that's diverse enough and you want to passively invest, then you got to find something that suits your strategy, something that you want to do your initial research, and then just keep investing for 10, 20, 30, 40 years, and just watch your wealth grow. Of course, it's a whole different ball game for active investors. But by means of knowing that these instruments exist, and by means of keeping an eye on these instruments, you yourself can be considered a somewhat active investor. You're on top of your portfolio. You're keeping an eye on what's out there, but you're not falling prey to the impulse need to actively trade stocks on a weekly, monthly basis. So yeah, there are two camps out there, and just try to find what works best for you. To be honest, some people don't want to actively trade stocks. That's fine. Some people just want to find a ETF that's very broad and diverse, and just keep throwing money at it for 50 years, and then voila, they walked away with £1 million, and that's perfectly all right. So just find what works best for you. Find a budget to invest with. So have it allocated out of your salary. That's what I do. My income comes in at the end of the month, and then the first of the next day I've got a little chunk going towards my investments without me ever seeing that money. So that's called paying yourself first, if you've not heard that phrase before. But yeah, just see what works for you, and just keep in mind that staying in the market beats timing the market, because you're never going to time the top and the bottom. So you might as well just keep dollar cost averaging in, or just throw a lump sum in there and see what works out. So Just remember that. I think statistically, as a passive investor, that definitely works. Whereas active investors may think differently. By all means, everyone's open to their own, welcome to their own opinions. And lastly, I've got some resource. So Banker on Wheels actually turned a year old a couple of days ago. So do give him a visit. I think he's a cyclist who also was a banker, and he's talking about passive investing. You've got other resources that might help you, educate yourselves. Motivator is great for funds. Morningstar is great for funds and ETFs. Yahoo Finance for individual stocks. Track Insight for funds, ETFs, and indexes. And stock screeners, you got again the same as Yahoo Finance, just a bit more advanced to help you identify those bespoke stocks to get you where you want to go. So by all means, give them a read. But by paying attention to this entire episode or my 8 episodes, you've already taken the first step towards ensuring that at least you are somewhat financially literate. So thank you once again for your time. If you got any questions, then by all means, catch me whenever in social or in person, and I'm always happy to help. Always happy to have a chat. And yeah, thanks once again, and I'll see you all again tomorrow for the last episode, which could be a fun one. There's a spoiler on the screen, obviously, but by all means, have a good one, guys. Take care and good night.